In the spring of 2020, the United States injected more money into its economy in a matter of months than it had during entire decades of previous crises. By mid-2021, federal stimulus measures totaled over $5 trillion, more than the inflation-adjusted cost of the New Deal, the Marshall Plan, and the 2008 financial rescue combined. At the same time, the Federal Reserve expanded its balance sheet from under $4 trillion to nearly $9 trillion, flooding financial markets with liquidity at a speed never before attempted. The immediate result looked like success. A depression was avoided. Stock markets rebounded within months. Household incomes, boosted by direct transfers, briefly rose even as millions stopped working. On the surface, the policy response to the pandemic appeared to be a triumph of modern economic management. But beneath that recovery, the data began to tell a more complicated story. By late 2021, inflation reached levels not seen in 4 decades. Asset prices, from housing to equities, detached from underlying productivity. Labor shortages emerged alongside declining labor participation. Government debt surged past 120% of GDP, a level previously associated with wartime economies. What began as emergency stimulus slowly transformed into structural strain. To understand how the world's largest economy moved from crisis response to systemic pressure, it's necessary to examine what happened during those first critical months, and why early warning signs were already visible, even as markets celebrated. The pandemic shock was not a typical recession. Unlike 2008, which originated inside the financial system, or the Great Depression, which followed a credit collapse and deflationary spiral, the COVID crisis was an externally imposed shutdown. Governments intentionally froze economic activity to preserve public health. Entire industries, travel, hospitality, entertainment, were switched off almost overnight. This distinction mattered. When demand collapses due to fear or financial stress, stimulus works by restoring confidence. But when supply is constrained by policy, injecting demand can create distortions. In 2020, factories closed, ports slowed, and global supply chains fractured. At the same time, trillions of dollars were placed directly into consumer and corporate balance sheets. The result was an economy where money was abundant, but goods, labor, and logistics were not. Early warning signs appeared quickly. By the summer of 2020, equity markets were rising even as GDP remained deeply negative. Price-to-earnings ratios surpassed dot-com-era extremes. Corporate debt issuance surged, with low-quality borrowers accessing capital at historically cheap rates. Credit default swap spreads narrowed not because risk disappeared, but because central banks implicitly backstopped markets. Housing markets provided another signal. Mortgage rates fell below 3% for the first time in U.S. history. Demand exploded. Home prices began rising at double-digit annual rates despite the worst labor market conditions since the 1930s. Affordability deteriorated, but leverage increased anyway. This pattern was familiar to economists who had studied previous stimulus-driven recoveries. Japan's asset bubble in the late 1980s followed prolonged monetary accommodation. Southern Europe's debt crisis emerged after cheap credit masked structural weaknesses. Argentina repeatedly experienced cycles where short-term relief postponed long-term adjustment until markets forced it. Yet in 2020 and 2021, the prevailing assumption was that inflation would be transitory, that supply chains would normalize quickly, and that emergency policies could be reversed without consequence. Policymakers pointed to muted price pressures after 2008 as evidence that balance sheet expansion was safe. What that comparison missed was scale, speed, and structure. Following the 2008 financial crisis, stimulus was largely channeled through the banking system. Credit demand remained weak, households deleveraged, inflation stayed low. During the pandemic, stimulus was direct, immediate, and global. Households received cash, corporations issued debt at record levels, governments ran synchronized deficits. Meanwhile, production capacity was constrained, not underutilized. By early 2022, inflation exceeded 7% in the United States. Energy and food prices surged worldwide. Central banks reversed course, raising interest rates at the fastest pace in 40 years. Liquidity, once abundant, began to drain from the system. Bond prices fell, housing markets stalled, bank balance sheets came under pressure as unrealized losses mounted. The transition from stimulus to strain had begun. This documentary examines the long-term cost of pandemic economics, not as a moral judgment, but as a structural analysis. The question is not whether stimulus was necessary. In the face of a sudden economic shutdown, it almost certainly was. The real question is what happens after emergency measures become embedded in the system. History offers sobering examples. The Great Depression taught the danger of withdrawing support too early. but it also showed that prolonged distortions can delay recovery. Japan's lost decade demonstrated how low rates and fiscal expansion can stabilize an economy, while simultaneously freezing productivity and demographic momentum. Countries like Venezuela and Turkey illustrate how monetary credibility, once lost, is extraordinarily difficult to regain. The United States is not those countries. It issues the world's reserve currency. Its capital markets remain deep and liquid, but structural forces, aging demographics, rising debt servicing costs, geopolitical fragmentation, and declining marginal returns on stimulus are converging in ways that challenge assumptions made during the pandemic response. For ordinary Americans, these macroeconomic dynamics translate into tangible pressures: higher rents, rising insurance costs, volatile job markets, and diminished purchasing power. For governments, they mean fewer policy options and narrower margins for error. For markets, they mean a repricing of risk that has been postponed, not eliminated. The era of emergency economics did not end when lockdowns lifted. Its consequences are still unfolding, slowly, unevenly, and often invisibly. Understanding how we got here is the first step toward understanding what comes next. Long before inflation hit grocery stores and mortgage rates doubled, the warning signs of post-pandemic strain were already visible in the data. They did not appear as a single alarm, but as a pattern. Subtle at first, then increasingly difficult to ignore. One of the earliest indicators was the disconnect between financial markets and the real economy. By August 2020, the S&P 500 had fully recovered its pandemic losses, even though US GDP remained well below pre-crisis levels, and unemployment was still above 8%. This divergence was not driven by improved productivity or earnings growth, but by liquidity. The Federal Reserve's asset purchases compressed risk premiums across markets, pushing investors further out on the risk curve. This behavior echoed earlier periods of financial excess. In the mid-2000s, low interest rates and abundant credit fueled asset appreciation, even as household balance sheets deteriorated. In Japan during the late 1980s, equity and real estate prices surged far beyond fundamentals under loose monetary policy. In each case, markets responded rationally to incentives, but the incentives themselves distorted price discovery. Another early signal emerged in corporate balance sheets. During 2020 and 2021, U.S. companies issued record amounts of debt, taking advantage of historically low borrowing costs. Investment-grade and high-yield issuance both surged. Many firms refinanced responsibly, extending maturities and lowering interest expenses. But a significant share of borrowing funded share buybacks, acquisitions, or simply liquidity buffers rather than productive investment. As a result, corporate leverage increased even as real economic output lagged. Interest coverage ratios looked healthy, but only because rates were near zero. This created a hidden vulnerability: balance sheets that appeared resilient under one interest rate regime, but fragile under another. Similar dynamics preceded the European sovereign debt crisis, where low yields masked structural insolvency until rates rose. Labor markets offered another warning. While headline unemployment fell rapidly, labor force participation did not fully recover. Millions of workers exited the labor market entirely. Some retired early. Others faced childcare constraints, health concerns, or skills mismatches. At the same time, job openings surged to record highs. This imbalance pushed wages higher, particularly in lower-income service sectors. On its own, wage growth might appear positive, but when wage increases are not matched by productivity gains, they feed cost pressures rather than sustainable income growth. By late 2021, unit labor costs were rising faster than output, a classic inflationary signal. Supply chains told a similar story. Freight rates multiplied several times over. Semiconductor shortages disrupted auto production. Inventory-to-sales ratios fell to historic lows. These were not merely pandemic aftershocks. They were symptoms of an economic system where demand was stimulated faster than supply could adjust. Commodity markets responded accordingly. Prices for copper, lumber, oil, and agricultural goods surged well above pre-pandemic trends. In past cycles, commodity spikes often preceded broader inflation, acting as an early transmission channel. During the 1970s, energy shocks amplified loose monetary conditions. In emerging markets like Turkey and Argentina, currency depreciation combined with commodity inflation accelerated price instability. Financial stress indicators also began flashing, quietly. While headline volatility remained subdued, measures like the MOVE index, which tracks treasury market volatility, rose sharply in 2021. This suggested instability beneath the surface of bond markets, even as equity investors remained optimistic. Liquidity conditions, particularly in longer-dated treasuries, became more fragile, raising concerns among central bankers. Housing provided perhaps the clearest early warning. From mid-2020 to mid-2022, U.S. home prices rose by more than 40% nationally, far outpacing income growth. Investor participation increased. Adjustable rate and low down payment mortgages reemerged, though under tighter regulation than in 2006. Affordability collapsed to levels worse than the pre-2008 peak. Historically, housing excesses rarely resolve without broader economic consequences. The Great Depression was preceded by land speculation. The 2008 crisis was triggered by housing leverage. Even Japan's stagnation was linked to real estate collapse. Rapid appreciation fueled by credit expansion tends to pull forward future demand, leaving a vacuum once conditions tighten. Perhaps the most overlooked signal was fiscal trajectory. Pandemic spending was initially framed as temporary, but by 2021, structural deficits remained elevated even as the economy reopened. Interest payments on federal debt were low only because rates were suppressed. As debt to GDP climbed past levels seen after World War II, long-term sustainability quietly worsened. This matters because fiscal and monetary policy are not independent over long horizons. When debt grows faster than the economy, governments become more sensitive to interest rate increases. This dynamic, known as fiscal dominance, has historically constrained central banks in countries like Italy, Greece, and Argentina, forcing inflation tolerance to preserve solvency. In the United States, reserve currency status delays but does not eliminate this tension. Individually, none of these indicators guaranteed crisis. Collectively, they painted a clear picture. An economy stabilized by extraordinary intervention, but increasingly dependent on it. The system was absorbing shock, but not healing underlying imbalances. Early warning signs are often ignored because they emerge during periods of apparent strength. Asset prices rise. Employment improves. Revenues grow. But resilience built on liquidity rather than productivity is fragile by nature. It requires constant reinforcement. The pandemic response succeeded in preventing collapse, but it also compressed years of economic adjustment into a narrow window. The longer those distortions persisted, the more painful normalization would become. The question was no longer whether the emergency response worked, but what it would cost to unwind it, and that cost was about to become visible. To understand why the shift from stimulus to strain was so abrupt, it's necessary to examine the mechanics of the pandemic shock itself. How money, markets, and real-world constraints interacted in ways modern economies were not designed to handle. At its core, the pandemic created a simultaneous supply and demand shock. This is exceptionally rare. In most recessions, demand collapses while supply capacity remains intact. Factories sit idle. Workers are underutilized. In those cases, stimulating demand helps reactivate existing capacity without triggering inflation. In 2020, the opposite occurred. Supply was deliberately restricted. Lockdowns closed factories, ports, offices, and service businesses. Global trade slowed. Labor mobility fell. Even as governments injected demand, the ability to produce goods and services remained constrained. This mismatch is critical. When demand rises faster than supply, prices adjust upward. That adjustment can be temporary if supply responds quickly. But during the pandemic, supply responses were delayed by policy, logistics, and behavioral changes. The transmission mechanism began with fiscal stimulus. Direct payments, expanded unemployment benefits, forgivable loans, and tax credits flowed into household and corporate accounts. U.S. household savings surged to over $2 trillion above trend by early 2021. For many families, disposable income rose despite reduced working hours. Next came monetary accommodation. The Federal Reserve cut rates to zero, restarted quantitative easing, and introduced emergency lending facilities. Financial conditions loosened dramatically. Credit became cheap and abundant. Asset valuations rose, reinforcing wealth effects that encouraged spending. This dual stimulus collided with supply constraints. Consumers shifted spending from services to goods, home improvement, electronics, vehicles. Manufacturing and shipping struggled to adapt. Inventories fell, backlogs grew, prices rose. Inflation initially appeared in narrow categories: used cars, lumber, shipping costs. Policymakers argued these were transitory bottlenecks. But as stimulus persisted, inflation broadened. Shelter costs rose, Wages followed, services inflation accelerated. At this stage, expectations became decisive. Inflation is not just a mechanical outcome, it is a psychological one. When households and businesses expect higher prices, they act accordingly. Workers demand raises, firms raise prices preemptively, lenders demand higher yields. These behaviors can entrench inflation even after initial shocks fade. History provides clear parallels. During the 1970s, oil shocks alone did not cause prolonged inflation. What sustained it were accommodative policies and shifting expectations. In Argentina, repeated stimulus cycles conditioned the public to expect currency depreciation, accelerating capital flight. In Turkey, political pressure on monetary policy undermined credibility, embedding inflation into daily life. In the U.S., inflation expectations began drifting upward by late 2021. Market-based measures such as Treasury inflation-protected securities break-evens rose. Consumer surveys showed declining confidence in price stability. The Federal Reserve, which had adopted an average inflation targeting framework, faced a credibility test. The response came swiftly. Beginning in early 2022, the Fed raised interest rates at the fastest pace since the early 1980s. Quantitative easing turned into quantitative tightening. Liquidity was withdrawn from financial markets. The shock mechanism reversed. This reversal exposed the second layer of pandemic economics: leverage. Years of low rates had encouraged borrowing across the system. Households took on larger mortgages. Corporations issued cheap debt. Governments expanded deficits. When rates rose, debt servicing costs followed. The same stimulus that cushioned the downturn amplified the tightening. Bond markets reacted violently. Prices fell, yields spiked. Banks holding long-duration assets faced unrealized losses. In 2023, these dynamics contributed to high-profile bank failures, not because of credit losses, but because of interest rate risk. This mirrored past episodes where policy shifts revealed hidden fragilities, such as the U.S. savings and loan crisis or Japan's banking troubles after its bubble burst. Housing markets slowed rapidly. Mortgage rates more than doubled, pricing millions of buyers out. Transactions fell. Construction declined. For households, the wealth effect reversed. For the broader economy, a key growth engine stalled. Meanwhile, global spillovers intensified. A stronger dollar, driven by higher U.S. rates, tightened financial conditions abroad. Emerging markets faced capital outflows and currency depreciation. Countries with dollar-denominated debt, like Turkey and Argentina, experienced renewed stress. Even developed economies grappled with energy shocks and fiscal constraints. This is the compounding nature of macroeconomic shocks. Stimulus can suppress volatility temporarily, but when normalization arrives, adjustments occur simultaneously across sectors. The longer imbalances persist, the more synchronized the correction becomes. Importantly, none of this implies that stimulus alone caused the strain. Structural factors played a role: aging populations, geopolitical fragmentation, declining productivity growth. But pandemic economics accelerated existing trends and compressed policy timelines. In economic terms, future demand was pulled into the present. Balance sheets were inflated to bridge a temporary shock. When the bridge ended, the system had to support that weight permanently. For individuals, this mechanism explains why prices rose faster than wages, why housing became unaffordable, and why financial volatility returned despite strong employment numbers. For policymakers, it reveals the trade-off between speed and precision. Emergency tools are blunt by design. Their side effects accumulate quietly. The pandemic response was a high-stakes experiment in macroeconomic control. It succeeded in preventing collapse, but it also tested the limits of coordination between fiscal reality and monetary credibility. What followed was not a single crisis, but a series of adjustments, each exposing a different fault line in the global economy. And to see where those fault lines lead, it helps to look beyond the United States. When evaluating the long-term cost of pandemic economics, the United States cannot be analyzed in isolation. The shock was global, the response synchronized, and the consequences unevenly distributed. Around the world, governments deployed stimulus at a scale previously reserved for wars, while central banks suppressed interest rates across currencies. The resulting outcomes offer a comparative lens, revealing which risks are universal and which are uniquely American. Japan provides one of the clearest parallels. After its asset bubble collapse in the early 1990s, Japan responded with repeated fiscal stimulus and near-zero interest rates. The strategy prevented mass unemployment and social unrest, but at a cost. productivity stagnation, ballooning public debt, and decades of subdued growth. Government debt rose above 250% of GDP, sustained largely by domestic savings and central bank intervention. The pandemic accelerated Japan's existing trajectory. Stimulus softened the immediate blow, but structural challenges, aging demographics, weak wage growth, and limited monetary flexibility persisted. Japan's experience demonstrates a central lesson. Stimulus can stabilize an economy indefinitely, but it cannot easily restore dynamism once debt dependence becomes entrenched. Europe offers a different cautionary tale. Following the 2008 financial crisis, countries like Greece, Italy, and Spain faced sovereign debt stress after years of cheap credit under the euro. When growth slowed, deficits widened, and bond yields surged. Without independent monetary policy, fiscal adjustment became unavoidable. During the pandemic, Europe avoided immediate fragmentation through joint borrowing and central bank support. But debt levels rose sharply, especially in already fragile economies. Italy's debt climbed above 140% of GDP. As rates increased globally, concerns resurfaced over debt sustainability. Credit default swap spreads widened, reflecting renewed market anxiety. Greece's experience remains particularly instructive. Stimulus delayed adjustment, but when financing conditions tightened, austerity followed. The social cost, unemployment, income loss, emigration, was severe and long-lasting. The pandemic response reduced near-term pain but did not erase long-term constraints. Emerging markets illustrate the most extreme outcomes of stimulus without credibility. Argentina has experienced repeated cycles of expansionary policy funded by monetary issuance. Short-term relief was consistently followed by inflation, currency collapse, and capital controls. During the pandemic, Argentina's inflation exceeded 100% annually. The peso depreciated sharply. Living standards deteriorated. Turkey offers a more recent example. Political interference in monetary policy kept rates artificially low despite rising inflation. Pandemic-era stimulus intensified pressure on the currency. The lira lost much of its value, forcing households to seek refuge in foreign currencies and real assets. Inflation became embedded, eroding trust in institutions. Venezuela represents the terminal case. Decades of fiscal mismanagement and monetary financing culminated in hyperinflation and economic collapse. While vastly different from the U.S. in scale and governance, Venezuela illustrates the endpoint of sustained policy distortion when productive capacity and institutional credibility erode. These cases highlight a spectrum of outcomes, not predictions, but constraints. Countries with deep capital markets, credible institutions, and reserve currencies can absorb stimulus longer. But no economy is immune to the basic arithmetic of debt, inflation, and productivity. The United States occupies a unique position. The dollar's reserve status provides extraordinary flexibility. Global demand for treasuries lowers borrowing costs. U.S. assets remain a safe haven during crises. This allowed the U.S. to run deficits at scale without immediate market backlash. However, reserve currency status does not eliminate trade-offs, it delays them. Persistent deficits increase debt servicing costs. Higher rates crowd out discretionary spending. Over time, fiscal space narrows. History shows that even dominant economies face adjustment when imbalances grow faster than productive capacity. The global comparison also underscores a key difference in outcomes. Distribution. In advanced economies, stimulus inflated asset values disproportionately. In emerging markets, it translated more directly into currency weakness and inflation. Both represent forms of economic strain, but experienced by different segments of society. Across countries, one pattern is consistent. Stimulus that outpaces structural reform creates dependency. Growth becomes increasingly driven by policy rather than productivity. Markets adapt by pricing and support. When that support is reduced, volatility increases. The pandemic compressed this process. Instead of unfolding over decades, many economies experienced in 3 years what others faced over 10 or 20. The result is a world more sensitive to interest rates, more exposed to debt dynamics, and more vulnerable to geopolitical shocks. For the United States, the global landscape matters. Slower growth abroad affects exports. Financial instability overseas feeds back through markets. A strong dollar tightens global liquidity, increasing the burden on U.S. foreign policy and trade relationships. Pandemic economics reshaped the global system, not by breaking it, but by revealing its limits. The question now is how those global pressures intersect with domestic realities. Because while international comparisons provide context, the real cost of pandemic economics is ultimately paid at home, in wages, housing, savings, and opportunity. And that cost is becoming increasingly difficult to ignore. By 2022, the consequences of pandemic economics were no longer abstract indicators on central bank dashboards. They had entered daily life for millions of Americans, reshaping how people worked, spent, borrowed, and planned for the future. What made this transition particularly jarring was the contrast: a labor market that appeared strong on paper, paired with a cost of living reality that felt increasingly unstable. Inflation was the most visible channel. At its peak, U.S. consumer price inflation exceeded 9%, the highest level since 1981. But headline numbers understated the lived experience. Essentials, food, rent, energy, insurance, rose faster than discretionary items. Grocery prices increased at double-digit rates in many regions. Rent inflation reached levels not seen in decades, with shelter costs becoming the single largest contributor to sustained inflation. For households without significant assets, inflation functioned as a pay cut. Wage growth, while elevated, lagged behind price increases for much of 2021 and 2022. Real incomes fell. Savings accumulated during stimulus years were rapidly drawn down. Credit card balances rose sharply, growing at the fastest pace since the early 2000s, signaling stress beneath the surface. Housing became the clearest fault line. Pandemic-era policies turned homes into financial assets at unprecedented scale. Ultra-low mortgage rates and excess liquidity pushed prices far beyond income fundamentals. When rates normalized, affordability collapsed. By 2023, the typical monthly mortgage payment on a median-priced home had nearly doubled compared to 2020, even before accounting for insurance and taxes. This locked millions out of homeownership while trapping existing owners in place. Inventory shrank. Mobility declined. Labor markets became less flexible as workers could no longer afford to relocate. Historically, housing downturns have been central to U.S. recessions. Even without a crash, prolonged affordability crises suppress growth and amplify inequality. Asset inflation created winners and losers. Households with stocks, real estate, or business equity saw net worth surge during the stimulus phase. Those without assets faced rising costs without corresponding gains. The wealth gap widened. This pattern mirrors post-2008 recovery dynamics, but at a faster pace. Small businesses experienced a different strain. While large corporations accessed cheap capital markets, many smaller firms faced higher input costs, labor shortages, and declining margins. Pandemic relief programs provided temporary support, but as those expired, survival depended on pricing power and scale. Business closures disproportionately affected local service economies. The labor market, often cited as resilient, revealed deeper shifts. Participation remained below pre-pandemic levels, particularly among older workers. Job switching increased, boosting nominal wages but also contributing to churn and instability. Benefits costs rose. Employers passed those costs on to consumers, reinforcing inflationary loops. Financial stress indicators among households worsened gradually rather than explosively. Delinquencies rose from historic lows. Auto loan defaults increased, especially among subprime borrowers. Student loan repayment resumption added another burden. These trends resembled the early stages of past downturns. Not yet a crisis, but a steady erosion of buffers. Psychologically, the shift mattered. Consumer sentiment fell to levels historically associated with recessions, even as GDP growth remained positive. This divergence reflects a key insight from economic history. Macro stability does not guarantee microsecurity. In the 1970s, growth continued amid inflation, but public trust eroded. In Argentina and Turkey, similar dynamics drove dollarization and social tension. For younger Americans, the impact was structural. Higher education costs, unaffordable housing, and volatile job markets delayed household formation. These delays carry long-term economic consequences, reducing future consumption and fertility, echoing patterns seen in Japan's lost decade. For retirees, inflation undermined fixed incomes. While Social Security adjustments lagged price increases, healthcare and housing costs rose faster. Portfolio volatility increased as bonds, traditionally a stabilizer, declined alongside equities. A rare but damaging combination. The cumulative effect was a sense of strain rather than collapse. Unlike 2008, there was no single moment of failure. Instead, the cost of pandemic economics appeared as friction everywhere. Tighter budgets, fewer options, higher uncertainty. This is often how long-term economic costs manifest, not as sudden crises, but as diminished resilience. When shocks arrive, there is less room to absorb them. When opportunities emerge, fewer people can access them. The American economy remained large, innovative, and flexible, but the margin for error narrowed. Each policy decision carried greater weight. Each rate hike, each fiscal choice, rippled more quickly through households already stretched thin. Understanding this lived impact is essential because it shapes political pressure, consumer behavior, and ultimately policy itself. And as those pressures mounted, attention turned squarely toward the institutions at the center of the response, the federal government and the Federal Reserve. As the long-term cost of pandemic economics became increasingly visible, the focus shifted to the architects of the response, fiscal authorities and central banks. Their challenge was unprecedented: how to withdraw emergency support without destabilizing an economy that had grown dependent on it. The Federal Reserve faced the most immediate dilemma. After maintaining near-zero interest rates and large-scale asset purchases well into 2021, it pivoted abruptly in response to persistent inflation. The policy reversal was swift by historical standards. Within 18 months, the federal funds rate rose from near zero to levels not seen since before the global financial crisis. Quantitative easing turned into quantitative tightening, shrinking the Fed's balance sheet. This speed mattered. Monetary policy works with lags. By the time inflation data confirmed persistence, much of the stimulus had already filtered through the economy. The Fed's delayed response risked entrenching inflation expectations. Its rapid tightening risked financial instability. There was no painless path. The 2008 crisis offered a stark contrast. Then, inflation was subdued, allowing years of accommodative policy. After the pandemic, policymakers confronted inflation in real time. The credibility of the central bank, built over decades of price stability, was suddenly in question. History underscores the stakes. In the early 1980s, Federal Reserve Chairman Paul Volcker raised rates aggressively to break inflation, triggering a deep recession but restoring long-term stability. In contrast, countries that hesitated, such as Argentina and Turkey, allowed inflation to become self-reinforcing. The Fed's actions signaled commitment, but at a cost. Higher rates exposed vulnerabilities across the financial system. Bond markets experienced one of their worst drawdowns in history. Banks holding long-duration securities faced unrealized losses. Liquidity conditions tightened, particularly in sectors reliant on cheap financing. Fiscal policy added another layer of complexity. Pandemic-era spending dramatically expanded the federal deficit. While emergency measures were justified, structural deficits remained elevated even as the economy reopened. This limited fiscal flexibility just as monetary policy tightened. Debt servicing costs became a central concern. As rates rose, interest payments on federal debt increased rapidly, consuming a larger share of the budget. Historically, high debt combined with rising rates has constrained policy options, forcing difficult trade-offs between social spending, defense, and investment. Europe's sovereign debt crisis illustrated this dynamic vividly. Greece's inability to roll over debt at affordable rates led to austerity and social upheaval. While the U.S. benefits from reserve currency status, it is not immune to the arithmetic of compounding interest. Coordination between fiscal and monetary authorities became increasingly delicate. Expansionary fiscal policy could undermine disinflation efforts. Excessive tightening risked recession. The margin for error narrowed. Regulatory policy also came under scrutiny. Bank capital requirements, liquidity rules, and stress tests were designed for credit risk, not rapid interest rate shifts. The pandemic exposed gaps. Policymakers were forced to deploy targeted interventions to stabilize banks without reversing broader tightening goals. Globally, central banks faced similar dilemmas. The European Central Bank balanced rate hikes against sovereign spreads. Emerging markets tightened earlier to defend currencies. Japan hesitated, wary of destabilizing decades of low-rate dependency. This divergence in policy responses contributed to global financial fragmentation. Capital flowed toward higher-yielding markets, strengthening the dollar and tightening conditions abroad. For developing economies, this created external strain, echoing the taper tantrum of 2013 but on a larger scale. For policymakers, the lesson was sobering. Emergency tools are effective in crisis but difficult to unwind. Once deployed at scale, they reshape incentives and expectations. Markets adapt, households adjust, governments rely on them. The pandemic response tested the boundaries of modern macroeconomic management. It demonstrated the power of coordinated stimulus, but also its limits. Stabilization was achieved, but normalization proved far more complex. Looking ahead, policy choices would increasingly involve trade-offs rather than solutions. Inflation control versus growth. Debt sustainability versus public investment. financial stability versus market discipline. These choices are not abstract. They shape tax policy, housing affordability, employment prospects, and retirement security. They influence geopolitical leverage and domestic cohesion, but policy alone cannot determine outcomes. As macro conditions shift, individuals and households must adapt as well. The question becomes not only what governments will do, but what people can do to navigate an economy shaped by stimulus and strain. That adaptation is already underway.